Then we have the next type, which is point and figure chart, commonly known as a tic-tac-toe. So point and figure charts originated in the middle of the 19th century by the first technical traders. It was not basically a chart, rather it was a forecasting method using point and figures. Most price charts utilized in the modern analysis are based on the opening price, closing price, high and low during a particular time period. But the point and figure chart is constructed based on just the closing price for the period. And so those charts are characterized by a series of X's and O's. And so the X's represents upward price trends and the O's represents downward price trends. And each box on the chart represents the price scale, which adjusts depending on the price of the instrument. And so for trading, you need to adjust the chart according to the two main parameters. Number one, box size. It is the number of points each box represents. Number two, reversal criteria. The number of points the price has to move in order for a column of X's to become a column of O's, or vice versa, of course. That is to create a new trend. So major features of the point and figure chart are as follows. Number one, the chart reflects price movements without time or volume concerns. So it can take from a few minutes to a few days to construct each column, depending on the price movement. Number two, the box in the tic-tac-toe chart doesn't represent a particular price. It represents a price range within the box size. So point number three, signals in the point and figure chart are quite simple. When an O box appears following a column of X's, it is a sell signal. If a new X box appears, and don't confuse it with a console, after a column of O's, a new uptrend begins, and so it is a buy signal. Point number four, support and resistance levels are especially important in point and figure chart. As it doesn't display highs and lows, these are clear horizontal lines. So when the price breaks them out, it is a signal to enter a trade. So next one, we have the tick chart. And so the tick charting technique represents a line display of rate swings represented in ticks. Tick is the minimum price range on the exchange. In other words, tick is each price swing. Based on this charting technique, the basic type of a volume in Forex or in other asset class is calculated, i.e. the tick volume. So when working with a tick chart, it is very important to have an idea of two prices at once, the bid and ask, because they represent a commission, i.e. the spread. And as long as the value of this commission changes depending on the swings frequency, there may be times when there is no commission at all or it becomes very big. So this type of chart is used in a special work strategy called arbitrage. Ticks displayed in the chart come into three main types. So first we have upward tick, which appears when a deal between a seller and a buyer was conducted at a higher price than the previous one. Number two, downward tick appears when the last transaction is made at the lower price than the previous one. Point number three, zero tick appears when the transaction is carried out at the same price as the previous one. And so the main features of tick charting trading are as follows. Number one, tick charts are sometimes called the chart of the market maker because it clearly displays all market changes of the price, for example, slippages. Number two, tick chart will suit you for trading only if your broker provides trading with minimum spreads or zero spreads, because the trends represented in tick charts are too short. Next type of charts is called Renko. So the Renko charting technique is a mix of a plain Japanese candlestick chart and the work principle of point and figure chart. Renko charts were developed to filter out the market noise that often appears in common charts during sideways trends or flats. So due to Renko construction principle, it rarely displays flat, so it seems that there are always trends in the chart. So to operate with the Renko chart, like with the tic-tac-toe chart, you need to adjust two major parameters. Number one, the brick size, which represents how much the price should change to draw a Renko candlestick in the chart. Number two, reversal criteria, which is the number of points in the price has to move in order for a new candlestick to form. And so this is a basic parameter which is twice as much as the Renko bar size. So now let's check the main features of the Renko chart type. Number one, Renko technical analysis charts excels at highlighting trends as it ignores noise, movements that are less than brick size. So number two, Renko charts almost completely filter out market noises, but you must remember that you need to trade in middle-term timeframes. Point number three, technical indicators like oscillators are much more accurate with this chart type. Point number four, sometimes you have to wait for a long time for a new brick, which can disrupt the work of your trading strategy, especially if you utilize expert advisors. Next chart type is Kagi. So Kagi charts looks like a series of vertical lines that depend on the price action and don't at all depend on time, like most of the common charts. The line in the chart changes its thickness depending on how high the price of an instrument oscillates. It is the variable thickness of lines in charts of this type that is the signal for traders to enter a trade. So this chart type is basically a technical tool as it combines major principles of EMAs, the exponential moving averages indicator. Kagi chart has a basic parameter of the trend reversal level that is by default 4% of the previous price movement. And so as for the major parameters, number one, when constructing a Kagi chart, the principle of signal accumulation is used when a reversal signal appears, then it is outbid. Number two, to get a more accurate signal, many traders use the combination of the previous Kagi interruption and an increase in the line thickness of the new Kagi. Point number three, chart type is excellent for trading in long time frames. In conclusion, we could add that the charting technique you choose directly relates to your trading strategy. If you trade the price patterns, then you choose candlestick charts or area charts. If trade in the trend, you like Heikin-Ashi or bar chart. If you trade based on mathematical technical indicators, then you need something very simple like a common line chart. If you utilize expert advisors and technical analysis indicators, you should remember that robots are developed for a certain chart type. Expert advisor is usually universal, but they are more efficient with a particular charting technique. And so many technical indicators are also developed for bars, candlesticks, and so on. Moreover, many traders employ several types of price charts to perform a more accurate market analysis and identify the market sentiment. So, define exactly your trading strategy and pick up the appropriate trading chart from those covered in this video. So if you have any questions, write them in the comments and I will be glad to answer them. Now I will end this video. Thank you guys for watching and goodbye.